Now, there's a lot of technical indicators out there that a trader can choose from. And one of the common questions is which one is the best one to use? In fact, the question of using a simple moving average or an exponential moving average, that's a pretty common question. And it gets worse when we start talking about the best setting because traders are always looking for some type of edge. So in this video, we're going to talk about which moving average is better. What is the best settings for easy gains? And does it even make a difference? Before we get started, click below. Hope you liked this video. Subscribe to our channel. Any questions or comments, you can put them below as well. And also don't forget to check out the disclaimer. Now, both the EMA and the SMA, they're useful when we're talking about just showing the average of price data over a fixed period. And all things being equal, the main difference between the SMA and the EMA is just the calculation, which influences how they're going to react to price. So the simple moving average, it's just a standard average of n periods, n being your look back period. So each price plot, it's given the exact same weight in the calculation. So you get a real average price for whatever look back period that you've decided to use. Because of that, the SMA, it just tends to be a little slower in reacting to price movements, including a sudden spike in price. And generally, the SMA is going to track further away from price in a trending market when we compare it to the EMA. With the EMA formula, there's actually a weighting factor in it that measures the most recent price data as more important. Because of this weighting, it makes the EMA quicker to respond to sudden price spikes. And because of this faster response to changes in price, the EMA will actually track closer to price. But keep in mind that when you use an indicator for decisions in trading, whether you're going to enter or exit, the faster it reacts to current price, the more chance of getting a false signal is going to occur. On this chart, one of the important areas to note is on the left side, because moving averages are just averages of price using the closing price. When markets begin to consolidate and the closing prices become closer to each other, price will generally just whip around the moving average. So if you're a breakout trader, a quick scan using a moving average can just give you a list of instruments that are in a consolidation. Another area is on the right. Now this gap down, it's a really good example of how the EMA reacted faster than the SMA to the price movement. And the SMA just kept climbing, but the EMA reversed direction to the downside. And as mentioned, this is just due to the most recent data having more meaning in the calculation than the previous data. For the most part, and during a steady move, there's very little difference between the two averages when you're using the same look back period. Now, what about using a larger time period? Does it make a difference? Well, that last example, we use the popular settings of 20. But if we go out to a common trend following period, the 200-day SMA and the EMA, is there a difference? Well, regardless of how you use moving averages for your trading, would you do anything differently with each of these averages? Probably not. Now the green arrow, it does show where the EMA reacted to the larger move, but it didn't really add any useful information to any trading strategy that I'm aware of. So was there a big difference? Not really. Now when we're talking about trading approaches, every trader is going to use a moving average a little differently in their strategy. And for myself, price action plays a bigger part in my own trading. The average for me just helps to frame the market, and I don't base any trading decision on the moving average itself. And I use a 20 EMA, and that's just what I've always used. So to help determine whether you should use an EMA or an SMA, let's look at determining the trend with a price cross, and we'll trade a pullback to an area around the moving average. So if we consider a trend changes when price just crosses and closes over an average, it makes little, if any, difference to the bias when you're using these two moving averages. In fact, in the middle of the chart, a double top formation and price direction breakdown actually gave you trend change signal faster than either average did. When we're talking about pullbacks, and a pullback to an area around the average is a viable strategy. The only issue we have is that black circle, because price did not touch either average. But for most traders, close is close enough. And price action, where we see price form a trading range and broke down, that would be enough for a short trade. So which one to use? Let's answer that question with saying the difference between the two, it's minimal. And really, if you have a robust trading strategy, it should make very little difference which one you use. We talked about the best setting. Well, just like the type, there is no best setting. A short-term trader who enjoys faster indicator movements as part of their strategy, they may use a 10-day EMA or an SMA. A trader may be looking for a short-term consolidation and will just use price hugging the 10-period SMA as a trigger to start looking for a breakout trade. Now, longer-term traders who don't really care for responsive indicators may choose a 50 to a 200 period SMA for a trend indicator. And as we saw when we were comparing the 200 EMA and the 200 SMA, being more responsive with the EMA made very little difference. You could even use something like the 100 SMA for longer-term trend direction and a 10 EMA for corrections against the main trend. All right, let me explain that with this chart of Bitcoin. So the 100 SMA is showing a downtrend as price is trading below it. You see price rally above the faster 10 EMA, and upon a close below the average, a trader could sell. Now, obviously, this is not a complete trading strategy that you should just start trading without doing some testing. You need stops, you need targets, and you also would need to determine how much price action you need to see on the opposite side of the EMA. Is it closed below the 10 EMA for a short? Is that enough for a trade entry? Or do you need to see the whole candle below the average? So the bottom line really is there is no best average. There is no best setting. You want quicker action on the chart for some reason? Just use a shorter period moving average, but just be aware of the false signals that it will occur. Do you like to see smooth price on your chart for a bird's eye view of the market? Well, then use a 20, 50, or 200 SMA. In the end, and the truth is this, a robust trading strategy should not depend on either the type of average or any slight variation in period settings, okay? We're just looking at an average of closing prices over a period of time. Now, that period of time could be a short period of 20 or a long period of 100 plus. It's really what you do with that information that matters, and that's the bottom line. Hit subscribe. Like this video. Any questions or comments, pop them below. We'll talk to you in the next video.